All right.
Good morning, everyone. Marlene Gonzalez with Canvas Real Estate. As you could tell, I've been busy this morning, right?
Yeah.
Well, here we are one more time with our favorite lender, Austin Palacios from First Origin Mortgage Lenders. Just keep in mind, he's in our office several times a week, even though he's a few blocks away and can help you pre-qualify your clients so they're ready to buy and you don't have any difficulties. All the types of loans that they offer, and at the same time, they have several down payment assistance programs. Okay, so today, what are we going to cover, Austin?
So today we're gonna be going over a CD. A CD stands for a closing disclosure.
Okay, now years ago, it used to be, we used to call it the HUD.
Yeah, the HUD.
So what has changed from a traditional HUD to a closing disclosure to an Alta settlement statement?
Well, I think the newer versions now are a little bit more detailed. We have the Alta especially. It breaks it down line by line over and over. And the CD is very nicely put together. It has the loan, it has the interest rate, the payment, all that stuff. And then on top of that, it has all the fees and stuff too. So
Right.
it's very, very
And they
organized.
organize it so
By sections.
anyone could really understand.
Yeah.
Okay. And it's done when?
It's so depending on the loan, right? So if you're doing on a primary home, you'll see the initial CD done 3 days before closing because it's called a TRID loan, right? And that's a TRID loan is a type of loan that it's insured by the government and it goes by certain guidelines. That way, it's not an aggressive lending practice.
What does TRID mean for people like me that don't know?
So TRID in short, without getting into the acronyms or anything like that, is basically just something that's very has guidelines more or less. It protects the consumers.
Very well, very well. So then you have full transparency.
Right, absolutely.
Now you said primary, but when it's a commercial transaction, does that apply as well?
Not always because I mean it's just not something I do very often, but no, it's more so the residential space than anything.
Okay, awesome, great.
Yeah.
Okay, but for example, if they're buying a residential property, but for investment.
So some programs do allow our TRID programs, right? So if we do a DSCR gift program, that's a TRID loan. But we have other DSCR programs that are not TRID loans. So it just really depends on the guidelines of the certain products we're fitting them in.
Right. And if you want to receive information about all these types of loans, please go ahead and send us a message. You can send me a message, Marlene at canvasre.com, and I'll make sure I pass it on to Austin because your email's a little bit longer.
Yeah, it is.
Okay, very well. Okay, so without further ado, we're going to leave the floor here to Austin, and he's going to tell us all about this famous CD that you should request for it if you're a realtor. And you should basically have knowledge of the different sections to explain it to your client, or even better, call Austin.
Yeah, absolutely. No, and listen, I'm sure people, have gone through it before and tried to explain a CD on their own. It's a little difficult, I would say, especially starting off. It's not something that's normally seen. It's not something that's taught in most schools. So this is a very important class, in my opinion, because at the end of the day, you have to make your client feel comfortable. And if you're able to go over a CD in full transparency and just explain everything outright, then your client will feel much better, right, at the end of the day. So a standard CD looks like this, okay? This CD, even though it says draft, was the final CD, right? I just couldn't export the final one, but this was the actual final one. So this is what the client saw at the day of closing. A CD is made up of a few different pages. As you can see, it's pretty long here. So these last 3 pages aren't much information that you'll be explaining to the borrower, but more so the first 3 pages are the most important parts, right? And you see there that there's a lot of information and you're going to be explaining it for quite a while. And if you do sit through a closing, you'll see that it does take about an hour to close because it's a few hundred pages of closing documents, and it's just not this, you know. So starting off, obviously we have the date issued. This one closed in June. So you can see here, if I zoom in, date issued 6/20. Like I said, TRID, you need a 3-day CD, because also you need 3 days, you know, to back out the contract or whatever you need. And then on top of that too, you need the teams to balance with each other's. So those 3 days allow for title, allow for the lender, and allow for all parties included to balance the CD, meaning they correct all the fees and make sure everything's picture perfect for the closing. Okay, so that way they're not missing a credit, they're not missing some fees that were disclosed from the title or government or escrows or anything in that sort of thing. But this top area is more so just information. So it'll tell you where your property is, your address, which is very important. I've seen a couple companies mess up on the property address. You'll see the title agency, you'll see the borrower, you see the address, you'll even see the seller, you'll see the lender, see the loan term, purchase, you'll see that if it's a fixed rate or not. You'll see the loan type, which in this case is a FHA, the loan ID, and so on and so forth, right? But now we get into the juicy part, because more so the clients already know the top part more or less. They already know who they're working with throughout the whole transaction. So you see the sales price here, 388. The loan amount was 380,972. So if you do some quick math, that's a FHA. They were doing 3.5% down, right? The interest rate they got in June was a 6.375. Recently, the rates dropped quite a bit. I think my most recent one was done at like a 5.75. So they have dropped quite a bit so far. So you can see on the very first page, you'll see monthly principal and interest. So right here is P&I. I'm sure when you guys are getting quotes from lenders for your clients and stuff like that, you'll see a line that says P&I. It stands for principal and interest. So this is that very first line, 2,376.77. You'll see here the prepayment penalty. There's no balloon payment. Keep in mind, on primary homes, it is illegal to have a prepayment penalty. Okay, so that's a very important note. And there's no balloon payments anymore. That's not a thing, really. So projected payments, right? Then you have your payment calculation, years 1 to 30. And it's basically just breaking down what they're looking at. You have principal and interest, 2,376.77, which we saw up here already. You have your mortgage insurance. FHA always has mortgage insurance, guys. All right. If you guys want to write it down, it's 0.55% of the loan amount is your mortgage insurance. Okay. Now, for conventional side, mortgage insurance could vary based on their credit report and credit score and their LTV. Right. If that's the case, we need to more or less see where the mortgage insurance stands. Because I tell my first-time home buyers all the time, if you could do conventional instead of FHA up front, I would do it all day. Because number one, your mortgage insurance comes off in X amount of years, and whenever you get 20% equity, right? But then on top of that, if your credit score is good enough, your mortgage insurance will be lower than the mortgage insurance on an FHA. So that's already savings off the bat. And on top of that, conventional allows you to do 3% down for a first-time home buyer instead of the normal 5%, right? Which is very nice. Obviously, saving that 0.5%, that's a few $1,000s. You can potentially go buy some furniture or invest the money into something else, and so on and so forth, right? But you can see here, you have the estimated escrows. Now, what are escrows? Escrows, in short, how I explain it to my clients, it's a piggy bank, right? It's a piggy bank for the end of the loan, because when you have your loans, they need you to have enough money to pay for taxes and insurance the next year, right? So basically that piggy bank is a little bit of savings for that next year to pay off both of them. I think that's the easiest way to explain it. And it's like the most like sincere and way to present it, right? It is a piggy bank, and it helps them in the future not have to come out of pocket for these expenses later on. And it secures the loan a little bit more, right? So then you see your total payment here. It's all of these numbers combined, and you can see it here, 2,761.86, right? And you go a little lower, you can see that this estimate includes property taxes, includes homeowners insurance, and it does not include HOA in escrow, right? So that's important note there. HOA doesn't never gets included in escrows because it's not something that's required, and HOA varies too, which is another thing. HOA can raise your HOA, or they can bring it down, and so on and so forth, right? So here you can see closing costs. He had about 15,234.28 in closing costs, and his cash to close was 16,444.10, right? And we'll get into the difference later on. So now we get into the juicy part, right? This is what I was saying, how the difference between the HUDs and the closing disclosures are so different, right? It's the organization aspect. Looking at this versus looking at a HUD a few years back, it's a night and day difference. You could see everything very lined out, very clean, and you could see it here, right? So the very first section is always going to be origination and anything in the loan, right? So in this one, the cost of the loan was 6,190.80, right? And we waived the underwriting fee, which underwriting fee usually goes about $1,500 or something like that. So we were able to credit that. And then the next section, right? We have services borrower did not shop for. So this is stuff like your appraisal, your credit report, funding fees for the lender, mortgage insurance premiums, which you see here. This is what makes, in my opinion, an FHA loan the hardest to explain on a CD. So they're gonna be like, hey, mortgage insurance premium, why are you charging me 6,552.35? Well, it's your lender's job to tell them that FHA has an upfront funding fee of 1.75%. So technically on FHA, they have the option of paying that upfront or financing that in, right? So we always take the option of financing it in because no one wants to pay an extra 6,552.35, right?
I have a question.
Mm-hmm.
Going back to loan costs.
Yeah.
I have seen percentage, I have seen broker fee, origination fee, underwriting fee. How come sometimes with other lenders, we see so many fees?
Yeah, no. So with other lenders with the other fees, they like to kind of hide where they're possibly charging and stuff like that. They'll even put, underwriting fee, processing fee, funding fee. They'll have a bunch of different fees, which can be a little elusive because they think it's going to all these different departments that are helping them fund the loan, but in reality, it's just money into their pocket, right? So more so, I think the best thing you could see is just one line, and that's it, right? Max two, because sometimes underwriting is kind of mandatory, but in this case, I was able to waive it. So they didn't have underwriting in this scenario. So they were happy with that.
Now, does it make a difference, the underwriting, if it's done in-house like you guys versus another lender or mortgage broker for that?
Yeah, I mean, it does make a difference because we'll tend to be a lot cheaper because a lot of these like brokers and guys with out of office underwriting will charge processing and underwriting, and it tends to be double the amount that we charge on our underwriting, right? So yeah, we did this. And going back to origination too. So if you see this broker fee of 6,190.80, we always try to make it a wash. So lender credits, I credited in them 8,187.09 credits.
Oh,
So we were just able to get, well, this specific client, we had to figure it out for them because MD, which is HAP program, right?
okay.
They were supposed to get 14,000 for down payment assistance. They qualified for it. We already did it. They ended up closing the program while we were in the process of getting it.
Oh, wow.
So they were like, hey, we're out of money. This is it. And that's the problem with working with down payment assistance. Like, we don't have the control. It's the cities, the counties, the state that all have the control over that stuff. So what our borrower was distraught. And I was like, look, I'll make it happen. I'll just try to credit you everything I can. I've talked to Ray. I talked to our investors, and we were able to make it happen with the credits. So we ended up crediting them basically the whole fee and then a couple thousand extra too. So they were ecstatic because, and actually, fun fact, he just sent me the bathroom because the problem was with the property, he needed to redo the kitchen and the bathroom. Um, Let me see if I can actually, I wonder if the share screen is gonna work though, if I move it to WhatsApp.
So that client
Yes, look at this.
is
He actually
very
just,
happy.
yeah, he just sent me this yesterday. So I wish you guys would have seen how the property looked before because it's night and day. He redid the bathroom was in shambles. He did the floors. Like it looks beautiful. I mean, the thing is, so this whole thing was closed off, and if it wasn't for the credits we gave him, because he only had like 23,000 and he was budgeting more or less. We got him to the same amount that he would have gotten with the MD program.
Mhm.
So without that, he wouldn't have been able to do the kitchen and the bathroom. So we kind of worked hard for him to make it happen. So yeah, he was super happy with that. But yeah, going on to the next section. So this section right here, like I said, services borrower did not shop for. These are just the loan costs and stuff like that. The biggest one is obviously Department of HUD. Everything else is more so tax service, that's government, verification of employment to PCB, that's a credit bureau. MERS is another funding thing. This is flood serve from CoreLogic, I'm sorry. And then credit report, that's another bureau. So like these fees are nobody's making money off these fees, you know. So these are standard fees, and this is exactly what it costs. Okay. All right, title. So C services borrower did shop for, right? So this is title. Your borrower always has the option of picking the title company for the most part. Now, realtors will suggest title companies when they're getting under contract. So just keep that in mind too. That's what usually happens, right? On refinances, usually the lender is the one that kind of refers the title company because we like to do people that we know and we work with and somebody who's cheaper too. That way we keep the low balance as much as possible down, right? So you can see here, there's a bunch of different fees. They had to do a survey. We had to do a courier because they had to close outside. We had document storage, archive, and you could see the different fees and what exactly they are. And every title company too, I've learned over the many years I've been doing this, everybody has different fees. Everybody calls their fees differently. So it's kind of confusing to tell which one is which at sometimes. Like for example, some companies will have a email fee, a wire fee, and then
Storage fee.
yeah, a technology fee, and then they have like a bunch of stuff. I'm like, why can't you just do that all into one fee? Like, why does it have to be itemized like that? But you know, it is what it is, and I mean, it makes sense at the end of the day. So a lot of these fees is what it costs them to do business, and so on and so forth. The biggest thing is lender's title insurance is the biggest cost here, as you can see. This is more so regulated throughout the state, so you won't see anything, you know, super high with lender's title insurance or anything like that. Um, Settlement fee is where that's basically their closing fee, right? So they'll make this on the closing every time, right? The 950.
Now that's on part of the buyer,
Correct. Yeah.
but the seller, if they have seller representation, which we
Oh,
highly
yeah.
recommend, the attorney that represents them will also have a fee, and I've
100%.
seen that fee fluctuate.
And you can see here, there's fees that the seller paid at closing too, right? So he paid a courier fee. He also paid a lien search, and then he paid for a title examination, and then he paid for a wire transfer fee, right? So he does have some costs here at closing. Right, now we go into taxes and government fees. Now this stuff, this is regulated. Nobody makes money off this except for the state of Florida and the counties, right? So you can see here, it's pretty hefty. It's 2,395.94 for just recording, stamps, and transfer taxes, which is pretty absurd in my opinion. But at the end of the day, every state has these, and I've done loans in Georgia, Ohio, Louisiana, the Carolinas, and they all have these, and they're all pretty high, so it's pretty standard. As you can see too, the seller also had to pay these too, so it's not just you at least, you know. So that's nice to see. So prepaids, I always get this question up front. So I as a lender, that's very personal. Let me zoom in now.
Yeah, that looks better.
I'm sorry about that.
It's okay. Thank you. Thank you for the people that need glasses these days.
No, I'm sorry about that. So, all right, I always get this question, right? Escrows and prepaids. Now, what even is a prepaid? So prepaids are something that you pay upfront, right? Hence the word prepaid, right? So for the biggest one, the biggest one I always get is the homeowners insurance. Why am I paying 12 months of homeowners insurance, and am I doing 3 months of homeowners insurance again for escrow, right? And you're like, well, the truth is that you have to pay for your first year of homeowners insurance. Okay. So that's the most important thing. Because if you don't pay for the 12 months up front, you're not insured for the current year, right? And therefore you would be closing without insurance. Therefore, the loan would not be secured in the way it needs to be, right? So every loan needs to close with insurance. Okay. Even if you don't do escrows, you still have to do the 12 months of insurance. And then on top of that, you do the escrows. Like I said before, it is your piggy bank for the next year. That way they're ready to go and pay for the taxes and insurance the very next year, right? So you see here, they had to escrow for $98.70 per month, which the taxes were super low on this guy. So he was super happy that we're able to do that. Now, so fun fact, it's underwriter discretion to use super low taxes on properties, right? In this guy's case, if you do the math, I think that the taxes came out to like 1,200. It was a homesteaded property. It had senior homestead exemption and widow homestead exemption. Usually, when they have senior and widows, they're gonna make you get the estimated taxes every time. But it's a gray area that's not really in the guidelines. That's up to discretion of the underwriter to decide if we can use those lower taxes or we can't use those lower taxes. But in my opinion, in the history that I've seen, anything that has widows exemption or senior exemption, you're probably not going to be able to use it, right? And it's good too because you explain that to the client up front, like, hey, like this is probably what your taxes are going to be. And then if you are able to use this, then obviously you save a lot of money at closing and you'll be fine, right? But you should always give the higher estimate first. And then if you go work backwards, then you look like a superhero, right? That's the main thing too. Always give a buffer of some sort, right? Here he got a credit for his taxes. So now we have other, right? What is other? It's literally itemized telling you where these fees are going. So all these are paid by the seller. You could see the accurate lien search. You can see this, it's the estoppel fee. You have real estate commission to Lifestyle International Realty. You have 13,580. I'm assuming that's the listing agent because my agent is Canvas. And then you have the Canvas commission, 9,700. And you guys will know the commission right away because you guys have the listing, the commission agreement and done beforehand. Seller's attorney fee, so he did have representation. He paid $1,195. Title's owner's title insurance to Howard Title, $60, which is very good. Transaction coordinator fee to Canvas Real Estate, $495, and their transaction coordinator fee, $495 to them as well. All right.
Now, is that transaction fee or our sales service fee? There's a difference.
I mean, here it says coordinator fee.
Right, they classified it as that, but the fact that it's $495 leads me to understand that it's truly the sales service fee for the handling of the file, which is different than one of our transaction coordinator handles the file from execution all the way to the closing table. And what's really nice about that is you don't have to worry. After the contract, our transaction coordinator provides that service to you and keeps you copied on everything. So that's another service that we provide here at Canvas Real Estate. And it's more inexpensive, by the way, if anybody's
Absolutely.
interested in knowing about that.
So as you can see here, these two lines are at closing and before closing, right? You have two lines here. So his total closing costs were 22,566.37. And then after the lender credits, you'll see below exactly what it was on the final. And then you can see here that the seller actually had to pay $28,527 too, because he's the one paying out the commission too. So you got to remember, you know, their closing costs are going to be pretty nice. So then this page is basically almost the same thing as what you just saw in the previous, but not really, you know, super nice and neat. It's pretty much the same thing. So you can see his down payment, the closing costs, the final closing costs, what he paid before closing, because this is what he actually paid at closing. And then when you take off like with the appraisal and everything else that you got. So you see your down payment, you can see your deposit that got deducted as well. Adjustments and other credits. You could see your sales price. You could see exactly what this is the seller side of the transaction as well. So you could see the county taxes, HOA fee that he had to pay. This guy also had to pay the HOA fee. So they both had to pay their part in HOAs paid by seller in advance. You could see it here. That's why it's on both sides.
This seller didn't have a mortgage, I gather.
Yeah, most likely not. He didn't have a payoff. So right here, paid already by or on behalf of the borrower at closing, right?
Can you elaborate what the unpaid utility escrow holdback is? A little bit down on seller credit.
Seller
So
credit.
they're doing a holdback until the final bill.
Oh, right here, yes. Yeah, absolutely. So the way a holdback works is somebody's literally holding the money, somebody has to pay for it, and then they'll give it back to you, right? That's how even in fix and flip loans, it works the same way. When you do a construction loan, they'll make you pay for, let's say, the roof up front, and they'll give you the money right back for it, right? So that works just the same. So apparently he didn't pay his utility bill, basically. He needed to pay it. Which happens, you know, stuff gets unpaid, such as the HOA balance I could see wasn't paid. So he had to go do all that stuff. You know, this type of stuff too, I always tell my borrowers when we're reviewing this page, I'm like, this is where the dirty laundry is aired out. Because a lot of stuff, if it's unpaid, you can see it right there blatantly, and you can see exactly what they're paying, exactly what their loan was, all that stuff. But you can see here that he has no payoff on first mortgage loan, and he has no payoff of second mortgage. So he had this house free and clear. So he was able to net whatever after his closing costs, whatever it was. So that's pretty nice. That's a good payday for him, for the seller. And I don't even think I met the seller, to be honest. I think he was out of the country for most of the time, if I remember correctly. He was an older man, super sweet though, when we talked to him on the phone. So adjustments for items unpaid by seller. Right here, you see county taxes. He was able to give my buyer that. And then again, you could see here the total closing cost amount. You could see the whole amount due at closing minus the loan amount, and this is what he had to bring into the closing, right? And here, this is total due to seller at closing. This is actually what he got minus what he had to bring in, because remember, sellers have closing costs as well. And then you could see he netted out $358,064.82, which is a nice payday for him. And then, like I said, these other pages are filler. They do have some information. It lets you know basically your loan does not have a demand feature. Assumption will allow under certain conditions this person to assume loan. Partial payments, and you know, stuff like that. And it's just good information to read. It's not super important to go over with the buyer at a closing this part of the loan package, because it's more or less everything that you just saw on the other pages. And this is where they sign. You can see everything here. You see the real estate broker, the real estate settlement agent, lender, mortgage broker, all that stuff. And then right here, they sign again. And that's it. That's the end of the closing disclosure, man.
But that's one of many documents
yeah.
they sign at the closing.
No, yeah, it's I mean, at the last closing we did, it was like what was it? It was like 150 pages or something like that. It was something absurd. The stack was like this big. I was like, damn, kill the tree to do that.
Even though after that you scan everything and it
Right.
stays digital,
Yeah, which is
which most banks want a wet signature, not digital, right?
yeah. Yeah, they like the wet signatures more. And especially it needs to be in black pen.
Really? I
Yeah.
thought it was always blue pen
I'm
for
pretty sure it's
legal.
I'm pretty sure it's black because I brought a blue pen one time and they told me no. So they had to use black.
Interesting. I think black looks darker. I remember years ago when I represented a law firm that everything had to be in blue. Maybe it's for government stuff or legal stuff.
Yeah.
That's a great question to ask ChatGPT.
Yeah. Yeah, everything's black pen. I see it here.
It is black? Ah, okay. Awesome. I just learned something new.
Yeah, I remember I remember we had to send a package back because it was blue.
Really?
Yeah, the investor wasn't taking it.
Now, I'm curious about something. So everything is signed, everybody's happy, they take pictures, so on and so forth. Can a bank come back to do a QC, a quality control after the closing?
Why? If they do, that's terrible. But I mean, it does
So do
happen.
not go to Rooms to Go or City Furniture
Yeah.
right after the closing, please.
Yeah, so man, I haven't seen it before at our office, but I've heard of other stories and it's pretty absurd. So what happens is a review of the purchase of the loan is done, right? So let's say a month later, 2 months later, or even weeks later or days later, when the loan is getting purchased on the secondary market, that purchaser will do a review of the whole loan again, top to bottom.
Like a month or 2 months?
No, it depends on how long they take to purchase it. For us, our investors on the secondary market take maybe a week, maybe a day or two, but they will actually review the whole loan from top to bottom, which is insanity. Because Ray will fund the deal, and then he'll sell the loan on the secondary market, right, to whoever it is. In this case, it was Lone Star. Another case, it's Newrez, Chase, whoever was the highest bidder at that point, right? So what they do is they looked at up and down, and let's say if the borrower lost her job a day before closing, and it was after we verified employment, they'll deny the purchase, and then you have to redo the purchase, or they just deny the file outright, or you refinance, whatever you can do to get it done. I've heard of one, they had a credit inquiry the day before closing too, and it was to order furniture, which that was a big one.
Like my client, I have in the past in West Palm Beach.
Yeah.
And I say, okay, the lender say, okay, we give you 3,000, but that is just for the closing. That money you need to give back to us.
Yeah. They spent it.
They went to the Rooms to Go, buy the beautiful dining room, and say, hey, what is my money? 2 days. No, I'm so sorry. I see that money in my account, and seriously,
Yeah.
I lost.
Yeah.
Yeah.
And she never referred me.
That's insane. No.
So the deal went sour because of that?
No. Pasó, pero era porque they need to see the bank need to see days before to the closing, the money. And they say, okay, I think that was my money. You don't have money. It's my money.
Yeah.
Yeah.
We tell buyers to not buy anything, do not spend a penny, but I've run across, it has happened to me, they go out and buy a car.
Yeah, it's pretty important to make sure you vet your borrower and get them ready for the closing. Obviously, clear to close is just one step. The second step is like, hey, wire it from this account. You know, that's happened a few times where we do 2 bank statements to make it simple, right? And we're okay, all your funds are in this account, you know, we're good. They transfer it to a different account, they wire it. I'm like, what was the point of that? Like, oh, I wanted to extend it from this account. It was easier. I'm like, well, now we have to document it, so we're gonna have to delay the closing. You know, so they held the funds. Title held the funds for an extra day, and they had to go back the next day and sign. You know, what's another one I've heard recently? Oh, this one wasn't even it was the borrower's fault, but it wasn't the borrower's fault. So like on all her pay stubs and documents, or her name is a certain way. I think it was like Maribel. But on her ID, it's Mary Bell, like Mary and then Bell, like Bell. And we were like, what? Like, so how do you know, all the taxes and stuff. So the ID, you know, got overlooked, and all the taxes and pay stubs and W-2s were all on Maribel. And her name, she calls herself Maribel, but it's Mary Bell.
I
So
guess
that
we
was
didn't have the ID
right.
before
So
that.
they had to basically just change all the loan documents, and it delayed closing a day, and then it got done either way.
But you know what? Sometimes the ID is not the same name, with,
The
No,
passport.
we had to ask
for example, with the record public
yeah.
for a letter, for
Yeah.
something, but oh my God.
In this case, it was though. It was the only one that was correct out of all the documents. And I was like, how does that happen? How is the W-2 and the taxes not the same as your ID? And she showed us her birth certificate, her passport, and it was Mary Bell on both of them. And we're like, well, we're gonna have to redraft these. So that would do it. I'm trying to think of other fun ones.
And at that point, they had funded already?
Well, yeah, we didn't fund the loan yet because we can't fund it until the full package is in, right? So basically, title holds all the funds, even if we disperse the funds. I mean, not disperse, because disperse means to the parties, but we send the funds to title, they had to hold it. If not, they had to wire it back if you don't get it done within a certain time period. I think it's like 2 days.
Now, even though you close, let's say Monday, and these things pop up that you need to resolve, get things signed. I believe there's a provision in the as-is contract that automatically the lender gets an additional 7 days to clear all these things.
Yeah, there's a little part of the contract that allows us to do that. Thankfully, we haven't had to use it, but yeah, I mean, I'm sure those lenders at least took a day to get that done with like the ID and all that stuff. So, but yeah, I think a good piece of advice too, even though you're clear to close, do not schedule closing until you have a balanced CD done. That is the best advice I can give you, because at that point, you schedule a closing, let's say at 10 a.m. You do it, then the package is not balanced, meaning all the fees are put in correctly by all parties. Then you're most likely going to have a delayed closing. You're probably going to be there for 5 hours for no reason, because title is not going to be able to get that done in an hour. You know what I mean? It's a lot of documents that they got to put together and stuff like that. And then the lender too, you know, keep in mind, title and lenders are all working on multiple files. There's only a certain amount of closers on both sides. So you got to give good enough time for them to be able to balance and stuff like that. And yeah, we will rush a file for you and get it done for you eventually, but morning closings are usually a mess, especially when the package is not balanced. When the package is balanced, whatever, you can close at whatever time you want, you know. But definitely afternoon closings are the better closings. So yeah, I think that's it for this class. Do we have any questions?
Any other questions? This was a great class because people get confused.
No, yeah, and it's easy to get confused. And I think the hardest one, just because of the fact of the upfront MIP, which is here, is hard to explain. So I think that's the best one.
And is that for the life of the loan?
Well, it gets rolled into the loan. So, I mean, technically, if you view it that way, then yeah, it's for the life of the loan.
Oh, okay. I thought that once the property had some equity.
No, so, you're talking about like regular mortgage insurance. So look,
okay.
FHA, so this is why it gets confusing to explain. FHA has upfront MIP of 1.75%. So simple math is you take the purchase price, 1.75%, That's that number right there. And then it's basically allowing you to get the low interest rate, low mortgage insurance, no matter what your credit is. You can have a 580 score and have 0.55 mortgage insurance. And it allows you to do 3.5% down, right? So that is what HUD charges. Now you have the option technically to pay it, or you have the option to roll into the loan. We roll into the loan because nobody wants to pay an extra $6,000 for something that's going to make your mortgage payment go up like $20, $30. You know what I mean?
Mhm.
So I think that's the best way to go every time. And then it has the regular mortgage insurance, which is up here, which is 170.72, which is 0.55 of your loan amount. So yeah, that's why I like presenting. I did this class for my LOs, funny enough, like a couple weeks back,
Yeah.
because I have my little team now. And they were like, oh my God, this is so confusing. I'm like, bro, I know. Like, you guys are new. You guys haven't seen a lot of closing disclosures. But the hardest one for sure to explain is this, because a lot of borrowers don't understand, or buyers and slash borrowers don't understand what the upfront MIP means and what it actually does for them. Directly, it's just an additional charge, right? If you want to see it blatantly. But actually, it helps them secure the loan, it helps you get that good interest rate, and it helps you get the low mortgage insurance, right? Because you can have a terrible credit score at 580 and you're still going to get 0.55 versus you go to conventional at 620, which is the minimum. Your mortgage insurance is probably going to be like 1.4 or something like that with a bad score. So you're saving, potentially almost triple sometimes, especially on like a condo, because property type plays a difference too. So if you get a condo, you have a bad score and low LTV, a high LTV, your mortgage insurance is terrible. I saw one a few years back. Her score was a 626. I'll never forget it. And it was a condo in Georgia. I'm like, okay, cool. We got her a good interest rate. It was a 6.125. We got her into the Home Ready program. And I go to get that mortgage insurance. I'm like, no way. It was 2.01 mortgage insurance. So then I was like, no way. I have to start quoting different people. I think it was 11 different mortgage insurance companies. And they were all in the twos. I was like, yo, this is absurd. But it's because her score was so low and it was a condo. And, and that's what it was at the end of the day.
Even though a condo insurance is included, but it's
Yeah, that's like hazard insurance type of
hazard
thing.
insurance.
But
okay.
now the mortgage insurance was super high, man. And the low score, she did 3% down only. So, and then on top of that, she only did, and then it was a condo too on top of that. So,
Well, if she only did 3% down payment, that means her credit was pretty decent, right?
no, it wasn't. We had to
Okay.
do your approval, luckily. The thing is too, she had a cosigner. So she was able to have like a better overall thing. But just based on her credit score alone was horrible. And it must have been just the area too. Because I think, in my opinion, I've done quite a few Georgia loans, and the mortgage insurance tends to be higher over there for some reason on conventional loans versus down here. So I don't know the correlation to that, but that's a real thing. And I've only done 2 non-QMs in Louisiana, so, and everywhere else was just non-QM, Ohio and the Carolinas. So it doesn't, like, those non-QM are the harder loans to do, like DSCR. Do you know what DSCR loan is? So a DSCR loan is basically a type of loan, an investment loan, that all we base it off of is credit score, your down payment, and your rental income you're getting from the property. So there's no need for taxes, no need for pay stubs, there's no need for anything like that. The most important thing is if your rent is making you $1 and your mortgage is costing you $1, that property qualifies for a DSCR loan. So that's the easiest way to put it. And for an investor that's trying to build like an Airbnb empire, they smash those all day because they don't want to put on their taxes. They don't want to do anything. They don't want to show taxes.
Right.
And they just do that.
What
And-
is the acronym? DSCR?
Debt service coverage ratio is what it stands for. That's kind of a mouthful. So definitely DSCR sounds a lot cooler and better. So, but yeah, DSCR is probably the hottest product out there right now. Everybody's doing them for the most part. Down here, you can actually, well, in general, we can do 15% down DSCR. But the standard is usually 20. And the reason I say the standard is because you won't debt service at 15% more likely than not, because taxes are high, insurance is high, and stuff like that. So you most likely will need that 20% down. If you get a property with low insurance, maybe you could squeeze the 15%, you know. But yeah, it's something to play around with. So it's a pretty neat program. A lot of people are doing it. And if you know people that are into fix and flipping and are not selling, because yeah, I've done like probably in like the last month, like 6 of them. People that are fixing flipping properties and they can't sell them because they've been sitting on the market a long time.
Right.
They're gonna want to DSCR it more likely than not. So if you know people that are doing that, that's all day. And most of the time too, like I have a guy right now that's actually he's doing a cash out refinance on his property that he was trying to fix and flip, and he's gonna buy land. So, that's another that's revenue for the realtor. So, but yeah, definitely if you have investors too, DSCR cash outs are probably the easiest things you can probably do. Because at the end of the day, you get a good interest rate. It's not the lowest, right? The lowest is probably like VA and FHA. Those guys are touching the 5s right now. Conventional is touching the low 6s. I would say DSCR is in the mid 6 to high 6s, maybe low 7s if the credit score is terrible. But yeah, it's still a solid program right now, more or less.
Wow, this is a great class.
Yeah, I can talk all day, but
Oh, I have a question because right now we're in the middle of a contract that was fully executed. It was a condo and the seller went to the
favorite.
association for the famous condo rider. So he finally got the association to answer the questions that are required in the condo rider paragraph 9, which was cool. But in this particular condo rider, the buyer is also requesting a bunch of other things they want to see up front. I don't know if all associations are the same, but since a lot of them work with portals now, this particular association has a portal, and I just finished a breakdown. And the seller has to pay $355 to get everything that they're requesting there on the condo rider, which is, in my opinion, ludicrous because these are documents that are available digitally. So for someone to go into a file and click, 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 this poor seller has to do that. And I find that happening more and more and more. And technically that contract is not fully executed just yet.
Yeah.
Because they have not been provided with all those documents. And after they do get everything, they have 7 business days to review and move forward or rescind. Even though this was a cash purchase, but let's say hypothetically that was a loan, a purchase with financing. I would tend to think that will get bottlenecked in the underwriting.
Yeah, I mean, it's unfortunate the way these condos are operating right now. I mean, and I'm working on a condo hotel right now. It's the worst service I've ever dealt with in my life. And
they do their own, or they have a property management company that handles their affair?
So it was their own, right? But then this place has like 3 different sections. So I have to give the condo questionnaire to 3 different people to fill out their sections. And each person takes a week to get it back, even though the due date for the condo questionnaire is an actual week.
Well, I've had condos and property management companies tell us that they are not the ones that need to complete that. And in that case, what I do, no, you're right, it's our responsibility. But in order for us to answer these questions, I need to ask you the questions. And you tell me yes, no, has or has not, because I'm not the one running the association, you guys are.
Yeah.
Well, but then again, it's like I always say, until the state of Florida regulates associations across the board, this is what we're gonna run across.
Yeah, it's havoc right now, man. It's probably the worst organizational structure ever, like in these condos right now in this day and age, you know.
Yeah.
There's a lot of fraud. You see it on the news every month. There's something of a condo right now.
Right, and the tragedy that happened in Surfside because
Right.
it wasn't managed correctly, so that's what they're trying to
Avoid,
avoid,
yeah.
but I know.
Which makes sense.
I know the Board of Realtors, through a lot of advocacy, is working with the legislation in Tallahassee to regulate these condos, and I know they're on their way. It's just, it's
gonna take
it
time.
means more work for us at the end of the day.
Yeah.
Okay.
It's probably gonna be years before something actually changes. Something else is probably gonna have to be drastic, unfortunately, for them to change it.
Okay,
As well as like property taxes. So supposedly I went to a meeting in Broward, it must have been like 2 months ago. And Marty Carr was talking about presenting something for first-time home buyers that was gonna make taxes cheaper, right?
in Broward.
No, and just in general in the state of Florida, he was presenting it to DeSantis. So
Oh, okay.
he said, quote unquote, it's on DeSantis's desk. So let's see what comes of that. You know, that would be nice, right? And I do see it consistently in the news that DeSantis is working on the taxes and stuff like that. And there's a bunch of different proposals. But that's up in the air, man. It's all speculation right now. You never know if it's actually going to come to fruition or not. If it does, it might take years, could take months, hopefully. But you know, who knows? You know, at the end of the day, they got a lot of stuff to deal with already. So-
Okay, this was a great class.
Yeah.
Thank you, Austin, as always.
You have someone that wants to buy in Ocala.
Yeah.
Like, no.
You have a listing up there?
seriously. No, I have a friend in I don't know, it's Lenaro. It's a listing consultant.
Yeah.
Mhm.
That is my friend.
Yeah.
Okay, so
Okay.
somebody that wants to buy an
Yeah,
Ocala,
yeah,
contact
his
the
phone.
office. And, well, it was a great class for those agents that could not connect. This is all being recorded, and by the end of the day, we will have it uploaded to our YouTube channel, Canvas Real Estate Miami Lakes. Until the next time, right, Austin? And
Absolutely.
thank you, thank you, thank you.
I'll see you guys later. Thank you for tuning in.